Shell is one of the few big leading oil companies across the globe, shaping our lives on a pretty much daily basis. But is this oil titan actually a good buy? How are they transitioning out of the pandemic, which was an absolute nightmare for the oil industry? And is Shell with their green energy plans actually a good long-term investment? This is Might As Well Invest, becoming smart money. On a quick side note, the YouTube algorithm has recently stopped pushing my videos. So if you want to help me out with no additional cost whatsoever, I would appreciate it if you could smash the like button, drop a sub, or maybe even share your take on Shell in the comments down below. Royal Dutch Shell, which was founded in 1907, is one of the few leading oil companies across the globe. Although they aren't necessarily the market leader, it still has to be said that they are quite a sizable force with their market cap of about 145.5 billion US dollars. But obviously this also does not come out of thin air and can to some extent be attributed to their revenue of about 180.5 billion in the most recent fiscal year. To add it right away, this is a sharp decline from the previous year, which in large extent can be attributed to the pandemic, but also the steep decline of oil prices in 2020. To however get a rough idea of what may drive Shell going forward, let's take a deeper look at their revenue. Shell divides their revenue into four segments, the biggest one being the oil segment with about 128.7 billion in revenue. This is then followed by integrated gas with about 33.2 billion and chemicals with about 11.7 billion. Last but not least, we then still have the upstream segment, which contributes the missing 6.7 billion. But enough with the brief introduction. Let's get to the interesting part for all of those who already are shareholders or want to become such, and that are the distributions to shareholders. Shell currently returns capital to their shareholders through dividend and to some extent stock buybacks. However, let's at first take a look at the dividend, which currently sits at about $1.33, equaling a current yield of 3.5%. Pair this with a dividend growth of 0 years and a declining 5-year growth rate of minus 18.82%, and you get a dividend that does not necessarily look as attractive as one would want it to be. When it comes to stock buybacks, these are a little bit harder to track. However, it can be said that they sat at a rather low 1.7 billion in the most recent fiscal year. But let's take an actual look at the numbers in order to see how sustainable these distributions are and whether we might even be able to observe a higher distributions growth in the future. First of all, we are able to observe free cash flow that is quite significant, but still experiences a rather decent drop after its peak in 2018. Obviously, this is largely tied to the current oil prices. However, it has to still be said that growth is always the ideal scenario. If we now, however, most importantly put the free cash flow into contrast with the distributions, we can see that these are quite sustainable in the big picture, giving us a rough idea about the fact that distributions were more so cut as a method of precaution and will most likely rise in the future. But let's also take a look at the balance sheet of Shell to get a more detailed overview of their financial position. As per usual, let's start out with the year of 2016, in which Shell's total assets sat at about 411.2 billion US dollars. These were made up by about 188.5 billion in equity, 92.4 billion in financial debt, and 130.3 billion in non-interest paying capital. But in order to be able to actually evaluate this even further later on, we want to calculate the net debt. This is obviously done using Shell's debt and its cash position of about 19.1 billion, with which we get the net debt of 73.3 billion. If we now compare this to the year of 2020, we can see a decline in total assets to about 379.2 billion, which to a huge extent can be attributed to the sale of some of Shell's core assets. But back to the total assets, which were made up by about 158.5 billion in equity, 108 billion in financial debt, and 112.7 billion in non-interest paying capital. Let's however again calculate the net debt just like we did for the year of 2016, with this year's cash position of 31.8 billion. This time we get a net debt of 76.2 billion, which is a rather minor increase. But let's also find out how sustainable the debt of Shell actually is and whether the debt has gotten more or less sustainable. This is done using the EBITDA, which after some basic calculations leaves us with a sustainability factor of 2.16 for the year of 2016 and 2.58 for the year of 2020. This indicates to us that the debt situation over at Shell has become a little worse, but still is in a rather decent state. Alright, so since we now have the financials covered, what we want to do is get the margin of safety, as this will help us with getting the fair price per share for Shell. First of all, I want to mention that Shell got out of the pandemic in a pretty decent manner. Right at the start, the company, for example, increased their cost-cutting measures to improve the bottom line and margins, not only during the pandemic, but also for years to come. This step was largely taken by Shell in order to be able to perform better even in times when the oil prices are in distress. However, I'm glad to announce that for now, these times of distress have largely passed, as the oil price recovered in a pretty rapid manner to the point where, in my opinion, more reopenings as well as a surge in demand are already quite priced in. On a quick side note, it has to also be said that OPEC has currently agreed to reduce the oil supply, which pushes the price up even further and stabilizes the market in general, allowing Shell to profit from the current situation. Therefore, I'm going to reduce my margin of safety by about 10%. However, it has to be said that I personally see the biggest upside of Shell in another factor, and that is their push into green and renewable energy. While it at first might sound like quite a stretch, I have to say that Shell's push into renewables is a really smart thing. Since, first of all, I don't think oil as a method of power generation will be around forever. Thereby, getting involved in alternative generation methods like wind parks is essential and also quite profitable, especially since many projects are subsidized by governments. And although I'm pretty sure this will be a huge revenue driver for the future, the biggest upside for Shell actually lies in their already huge gas station network. This at the moment provides them with a way to sell their oil in the form of petrol direct to consumers. If we now look into the future with EVs, it is quite feasible to say that Shell can and will become a huge player by again selling their power generated directly to consumers through charging stations. Therefore, I see major potential for Shell in both the EV but also energy generation space, for which reason I will be reducing my margin of safety by about 10%. However, it has to be said that it's not all sunshine and roses over at Shell either. As it has to be said that first of all, the side effects of the pandemic aren't fully over yet, thereby possibly leading to another downturn in oil prices if traveling shouldn't step up big time in the summer. More significantly, I however think that Shell's management is at this point of time somewhat failing. While it is great to get into renewables, it for me is quite hard to fathom why they would start selling major oil assets at bottom level prices. They don't need the cash, as we have found out just a few minutes ago, and neither is it like oil is going to disappear from one day to another. Therefore, I will add 10% to my margin of safety. To now get the fair value of Shell, we have to take a look at the historic dividend yield. For the past 10 years, this sat at an average of 5.88%, thereby meaning you want to buy the stock if the yield is above that. To put it into numbers, with the current dividend of $1.33, a fair price to pay would be $22.61, which would mean with the current share price of $38.03, you would have to pay a 68.2% premium. Note, this is only in respect to the dividend though. If we now want to calculate the value I would pay for the stock, all we have to do is again get the average dividend yield of 5.88% and add my safety margin of 15%. This gives us our target yield of 6.76%, which leaves us with a price to buy the company of $19.67. To sum it all up, I think Shell has a pretty decent long-term outlook. They offer an already huge and established gas station network, which could rather easily be converted to EV charging, and trust me, this is a huge market. In addition to that, there is obviously also decent growth potential in the basic energy generation segment. And although oil won't disappear from one day to another, I'm sure it is extremely wise to roll over your profits into these new markets if you want to stay a market leader for the long run. Therefore, I would currently rate Shell a hold. Obviously, unless you definitely want to get into the oil industry, in which case I personally see Shell as a pretty good play for the future.